Good evening, friends. Hope you are well and doing fine. I'm Ashok Kanawala. On behalf of HDFC Mutual Fund, welcome you to this call to discuss the opportunities in the large cap segment. As we all know, for last couple of months, especially from end of September, the markets have been seeing a heightened volatility. Of course, the first phase of that volatility was arising out of the news flow, which were not very encouraging in terms of slowing economy and earning downgrades and some concerns arising out of valuation, and of course thereafter arising out of the geopolitical tensions, or maybe I would rather be more specific, coming out of outcome of the U.S. elections and the tariff war. Uh, but from January onwards, some of the steps taken by the government was in terms of that the budget that announced was which was a consumption-oriented budget, but it was an eye to boost the economic growth, and thereafter RBI also cut the rates. But when we look at the market behavior, that doesn't seem to be enthusiastic time for the present. So whatever positives are coming to the market are getting ignored, I would rather say. And more so, particularly in the case of small and mid caps, where the brunt has been more severe as compared to the large caps. So, when we talk about the large caps and we talk about the various market segments, so we have been very, candid about our sort of thoughts on the market. And as you all are aware that we have been doing this call series every month around middle of the month, and we share our thoughts on various market segments and market outlook, economy, and we have been sounding to you what are our concerns regarding the markets and where the opportunities have been lying. So today we have with us Rahul Baijal, who is our senior fund manager for the large cap strategy. And for the viewers who continuously remain with us over the time and who had an opportunity to hear Rahul's view in the month of October when we did last call with him, he was quite clearly in his thoughts how the markets are looking in terms of valuation, etc., and where are the opportunities. So proof of the pudding is in the eating. So before we begin this, let me show you a small video that of the last our call that we did in the month of October, so that we are very clear at the inception only that what we believe is what we say, and that's where the opportunity lies. So as we all know, as I said, that we did this call in the month of sort of in the month of October. And this is what Rahul had to say at that point in time, who was the fund manager for the large cap strategy or HDFC Large Cap, which was earlier known as HDFC Top 100 and before that HDFC Top 200. So let me play this video for you guys.
If you look at the last two big corrections, we saw a sharp price correction between 2018-19, as you can see over here, and then you saw a phase of time correction in 2022. Right now we're in the midst of a very hot phase. Keeping the valuations in perspective, and although the quality of mid and small caps have gone up a lot, but I think there are pockets of froth in some names in the broader market, which makes me a bit nervous, whereas the large cap valuations are still reasonable. And given that cycles come and go, I think there's a high chance that some sort of reversion happens over here. The large cap returns have been around 13%, and there is convergence with the small cap returns, which are also around 13%. So some sort of convergence, I think, is due, and we've seen a very sharp hot phase, and valuations are telling you a story. So my advice and my recommendation, and this is a personal view, is that it's probably a good time to do some reallocation shifts. If you have a very highly considered broader market portfolio, maybe do some 10, 20, 30% allocation shifts towards the large cap oriented products, including large caps, funds. SIPs can continue as in the long run.
So as you can see from our earlier commentary that we were very clear in our thoughts as far as markets were concerned, and we were cautioning investors that why they need to be more large cap oriented as compared to small mid cap. Even on the same breath, when Chirag Satalwad used to come on the call, who manages small and mid cap, he also have been cautioning our investors, and actually it has been playing out. And how it is playing out that people tend to look market from a say 1 year perspective or whatever. So when you have before years that if this large cap would have say given return of 4% because the way large caps in general have behaved. But if you really see today, all whether mid cap, small cap, or for that matter 500, which is a much broader market, they all are behaving same in same kind of return. And in fact, small and mid cap actually have started doing rather performing lower than what large cap category has been doing. But if you look back this data, say month ago, maybe end of January or maybe end of December, the figures would look completely different. But our job here or our suggestion is always just to warn you people, and so that you can start taking a decision which is more, it's more conducive to your wealth creation process. And therefore, what we can see that the September 26th is right when the market picked out, and now we have seen this a bear market or a correcting market for last 5 months, and you can actually see that the mid caps and small caps are performing more badly as compared to large caps. And that's how in if you see no, it's not that large cap as a category has not fallen. We also have gone down by minus 13% since the drawdown period, but we are significantly falling less than the small and mid cap as a category, or for that matter even 500, or even for that matter its benchmark, which is Nifty 100. um, what is this large cap all about? Of course, we have Rahul Baijal, who's our senior fund manager and been with us for now more than 2 years and has a fund management experience of more than 2 decades. And how we have been managing strategy, of course, we will hear from him shortly. But we always have been true to label. So when I say true to label, when you say large cap, nearly 93% of his exposure is in large cap, mid cap is around 6%, and nil to small cap. Whereas the competition has been 84% around large caps and 7 and 5 to around 12% to mid and small. Perhaps maybe 1 or 2 months back, they would have been performing better than us because mainly of their perform or exposure to mid and small category. But now that also has been reversing, and therefore somewhere Rahul seems to be have been managing his portfolio well in the drawdown phase. And it has been our core philosophy at a fund house level that rather than being a top performer, it is better to be avoiding bigger mistakes because corrections or a drawdown are part of the market, and at times it becomes easy to make money but very difficult to preserve that corpus. And that's what we intend to do through our fund management or risk management framework that avoid big mistakes. Eventually, that will lead to sort of a wealth creation for our investors. So today, when the market sentiments are like a pendulum, it oscillates from optimism to pessimism, and it's more on the sides of pessimism right now. So we have Rahul Baijal, who will speak about his thoughts on the how he's seeing the economy, and especially when budgets have been announced and how he sees the implication of that budget playing out over the next couple of months. And markets are always forward looking. So how does he look at market from say a medium term horizon? And of course, thereafter he will talk about the valuations part of it, and of course then more detail. What does he think, and how does he think that large cap HDFC large cap fund, how is it positioned right now, and how he thinks that that strategy will play out from a medium term perspective. So with this view, I will invite Rahul to share his opening remark, and I have with me my colleague Sandeep Singhi, who will help me moderate the call once Rahul is done with his opening remark. So I'll stop sharing my presentation here. Of course, these are the other presentation which you see this performance of whatever his scheme that we have to disclaimer as a part of that. We have to show this. So we are showing that this is how the fund has performed over the years. So if you can see even the SIP, which is like 34 lakh, is today worth 3 crore 98 lakhs or whatever. So, sorry, 8 crore 52 lakhs, and the benchmark is around 3.98 crores. So you have over a period of time done much better than the benchmark. That's what the message is coming out very clearly. So I will stop sharing the presentation here, and I will invite Rahul Baijal to make his opening remark. Over to you, Rahul.
Yeah, thank you, Ashok. Uh, good evening, everyone. What I'll do today is basically share my thoughts across the following four areas. Firstly, I'll give you some perspective on the short-term concerns on the slowdown in the economy and why I am more cautiously optimistic that things will get better from here onwards. Then, secondly, I'll talk about the market, the correction, how the valuations are looking post the sharp correction we've had in the last few weeks, months. Thirdly, I'll come to some of the concerns and some of the key issues, key monitorables in the market, locally, globally. And lastly, I'll end with the large cap fund positioning, and then we can move on to Q&A. Firstly, on the economy, I won't go too much into the big picture. I think the big picture outlook for India to continue to be a 6-7% real GDP growth and 10-11% nominal GDP growth over the next 5-6 years. I think that remains the same, and nothing much has changed on that front. And as we progress in this journey, we'll become the third largest economy in about 3 years' time. What's changed is the short-term cyclical slowdown, which began in middle of last year, and I'll talk more about it in terms of what are the three reasons for the slowdown. But before I go into that, just quickly on the numbers post the budget. This is a summary of the last 2 decades, how the various macroeconomic parameters have fared, and growth has been fairly resilient over the two governments, two teams which we've had over the last 2 decades. And the latest projections are of about 6.4% GDP growth for FY25. First half has been about 6%. The third quarter number will come in February. And next year projection, as per the latest RBI meeting which happened, is around 6.7. So it's already building some optimism, some acceleration, which I am convinced about, and I'll go deep into that as we go along. Inflation clearly has come under control from 6.7 2 years back, trending down to 4.8 and 4.2 going forward. And this, along with the budget fiscal consolidation roadmap, has clearly paved the way for the RBI to start cutting rates and start improving liquidity, which we have begun to see. So, what are the three reasons for the slowdown? I think, firstly, because of elections, you had decision making getting a bit awry, and there were some changes in the bureaucracy in Delhi, and that's why we saw that the central government capex slowed down sharply from May, June onwards, and the elections happened in June. In fact, in May, June of 24, for those 2 months itself, the YOY drop in capex spending was more than 50% YOY. So clearly, getting busy in the elections had a big impact, and that has built up into causing a slowdown through the rest of the year as far as capex is concerned. The latest projections which have come in the budget indicate that we'll probably have about 5-6% growth in FY25, followed by doubling of growth to about 10% in FY26. So clearly on this parameter, we have evidence also from December onwards. The capex pickup has been quite sharp. In fact, the December number was up 70% YOY. The November number was up 20% YOY. So these whatever slowdown had to happened till October, and you're seeing a pickup from the central government side. And I think as we go along this year, in most of the months, you should have reasonably attractive double-digit YoY growth to continue throughout the calendar year. So this aspect of the slowdown, I think clearly the reversal has started to happen. The second aspect of the slowdown was the urban consumption, which I think will take slightly longer to recover. So this is a very interesting table. It talks about how you can split India in terms of 30 crore households into five quintiles of 6 crores each. And interestingly, what you'll see is the top two quintiles, the top 12 crore households, they always remain, their incomes always remain higher than the expenditure, and they always remain a surplus zone. But the bottom two quintiles, the 12 crore households at the low end of the income, their expenditure is usually higher than the income. So they always remain in a surplus negative zone. And this is where, social welfare schemes and the state populism, which we are seeing in the elections, is coming in to support this segment. And I think this will continue. But the slowdown comes mainly from this Q3, Q4 area, because this is a very narrow surplus segment. And the moment there's a slowdown, this segment slips into the negative zone and causing, short-term slowdown. So I think this is what is happening. Food inflation, rental inflation, high interest rates, and reduction of savings, excess savings post-COVID, jobs issues, lower wage hikes, all that has been building up for this segment and causing this, short-term slowdown. So what the budget has done is basically given a urban consumption stimulus, which is equivalent to a one-time 4 to 5% kind of a hike at one go. And this will be followed by another hike, which all these salaried class people will get at their respective companies. So I think on the back of this, you'll have a sharp jump on the disposable incomes, and that should lead to some sort of an improvement in terms of consumption as we go in the year forward. My sense is around Diwali is when we should see a reasonable pickup in the data coming up on the urban consumption front. So this part may take slightly longer to pick up. The third aspect of the slowdown was this sharp deceleration in the overall system loan growth from about mid-teens to 10%. And this 5% deceleration caused a big slowdown as far as the credit multiplier is concerned in the economy. On this front also, we have seen that the new RBI team which has come in place is clearly announced that a lot will be done to boost the liquidity measures because liquidity has been running tight for a long time. And we already started seeing OMOs happening, VRs happening. The first rate cut has also happened. And I think more measures will get announced in the following months to ensure that liquidity moves to a surplus, and that should lead to deposit growth picking up, and eventually loan growth should also pick up. So I think this aspect of the slowdown also should reverse next year. I'm expecting at least a 2% acceleration in the deposit growth in FY25 to FY26. So I think on two out of these three aspects of the slowdown, I'm quite optimistic that things will get better, and we will clearly move from 6.2, 6.3, 6.4 number in FY25 to more of a 6.6, 6.7 number next year. So that is the view on the slowdown and why I see optimism ahead in terms of the recovery. Then coming on to the budget, one more thing which the budget has done is for the first time any large country has given this debt to GDP ratio roadmap, which actually basically says that over the next 5-6 years, our sovereign debt to GDP will decline from 57 to 51%. And within this journey, the government will have the flexibility to manage the fiscal deficit the way they want to. So what this does is this will give a lot of flexibility to the government over the next few years on an annual basis, how they want to, manage the fiscal consolidation without committing a number in advance. And I think it's the first time any large major country has given this roadmap. So for me, this was a big positive takeaway, and I think the international community has taken this well as well. So that's on the economy, the short-term concerns, and the optimism ahead. Another aspect which gets discussed is the private capex outlook. A lot of narratives out there. Is it slow? Is it bad? So I think it's not as bad as the narrative. If you look at the raw data till FY24, till the elections happened, actually private capex was growing at about 18-20% CAGR over the last 2 years. But weakened, and utilization levels also didn't pick up at a pace because of the demand side issue. The private sector capex has taken some sort of a breather, but I think once the urban consumption stimulus picks up, next year we'll have pay commission as well, and the government capex is already picking up. I think they'll come back. They'll come back with a lag, but it's not that this has disappeared for good. So I'm optimistic here also, but I think this will also take time. Probably by end of this year, early next year, we should see improvement on the private capex number as well. So that's the overall view on the economy and the outlook. Then coming on to the markets, as you know, in the long term, earnings follow the GDP growth, and eventually the market returns follows earnings. So I think that story remains intact. But in the short term, what has happened is that the earnings slowdown, which began in 1Q FY25, 3 quarters back, has led to some sort of a earnings downgrade cycle kicking in across the broader market, even some large caps. And on the back of these earnings cuts and earnings slowdown, we have seen the full year earnings growth number, which used to be about mid-teens about a year back, has got downgraded to about mid-single digit. The 9-month growth in the results season so far has also been close to 5%. And now the focus is shifted to how next year will be like. Will it be mid-teens? Will it be 10%? I think we'll get clarity more on this over the next 2 quarters. And that's when there'll be more confidence on the recovery ahead. In the meanwhile, globally also, dollar was strengthening, and there was, a reversal of flows from emerging markets. So earnings slowdown combined with dollar strengthening and with high valuations, which, like mentioned, we have been warning about, and we mentioned in detail about that in the October webinar as well, when valuations in the broader market were sitting at multi-year peaks. Valuations have corrected. Some earnings cuts are also happening in the broader market. And in the large cap also, we have seen some correction on the back of huge FI selling. But now the valuations are far more reasonable, although in the broader market, the premiums to historical averages still remain. And I'll come back to this later again. So what are the other concerns globally, locally? I think good news on the US front is that if you look at September to December projections over here, this is the Fed data. Growth outlook has significantly improved on the GDP front. Unemployment rate is also better, but inflation estimates have also got upgraded from 2.1 to 2.5. So on the back of better growth, better employment levels, but higher than expected inflation, and the uncertainty around the policies of the new government on tariffs, I think the Fed has gone on a prolonged pause. And my sense is only when you get more clarity on the tariffs, the trade negotiations, and inflation data over the next couple of months, I think the earliest the Fed will resume its rate cut cycle is probably middle of year. But for the time being, I think they've gone into a prolonged pause. Um, Global growth has been moderating, but still okay, around 3.2% last year and 3.2 projected for next year as well. Some countries are accelerating, some countries are decelerating, but no worries of a recession anywhere. On the geopolitical front, I think there's good news. For India, oil is always a worry. And I think what we have heard from the US government so far clearly is good news, because they have clearly publicly stated that they want oil prices, at least the oil production, to go up from both within US as well as from the Middle East. And what this means is that oil prices are likely to remain soft, and I think that's good news for India, because we import 80% of our oil, and whenever prices go up beyond $85, we have a problem of inflation which starts creeping up. So good news on that front. And once the war mitigation happens in Ukraine and Middle East, both also policy intent of the current Trump team, I think that should further aid the sentiment around softer oil prices. So good news for India. Coming on to the currency, which has been a worry and also one of the reasons why FIs have been selling India since October onwards. So Indian currency depreciation, I think, is more an issue of dollar strengthening. But if you look at versus the other currencies in the emerging markets, India has actually done pretty well. So nothing to do much with India. It's more a global phenomena. It's the whole view change around the Trump team and their policies and dollar strengthening, that rupee has weakened. And I think my sense is that we are also coming to probably the fag end of rupee depreciation as well for the short term. So that's a quick summary of the key issues around the market. Earnings slowdown last 3 quarters, likely to continue at least for the next 2 quarters. Valuation risks, yes, corrected, but still a reasonable premium versus history in the broader market. Large cap valuations far more reasonable. Rate cuts, prolonged pause by the Fed, tariffs, trade wars, I think will continue throughout the year. Geopolitics, good news for India, de-escalation, oil price remains soft, and in terms of recession, broadly no worries, although some slowdown. So that's the view on uh, the other macro parameters. Then coming on to the third aspect, which we've already shared initially. Ashokji shared the views on the relative attractiveness of large caps as were presented in October 24. And I think my personal view hasn't changed much. What we have seen is a correction in the large caps from here to about here. And now the premium has become quite modest and broadly in line with the 10-year average. So I'm quite constructive on valuations over here, and I have used the correction in the last few months to deploy whatever cash of 5-6% I had in the large cap fund to less than 1%. Even the premium to emerging markets has come down a lot. It's actually broadly in line with the 10-year average. On the earnings front, like I said before, I think the slowdown, the cuts may continue over the next 2 quarters, and only by June, July, we'll get clarity on where we are heading towards earnings growth as far as FY26 is concerned. I think this should come get visible by middle of this year. Valuations, broader market, very frothy in October. A lot of froth, I think, has gone out in the last few months. But in parallel, what has also happened is some earnings cuts. So if you look at valuations post the correction, and this is January ending, we had another 4-5% correction from here in February. Even if you build that, I would say valuations are still far away from the long-term averages. So if mean reversion has to happen, difficult to say whether it will happen fully, then probably some more way to go through. But overall, a lot of froth has already been taken out from the broader market. Then coming on to the question of FIs, when will they come back? Why have they left? I think in terms of the return experience in India, I've shown this slide before. Only two markets in the emerging market space have given close to double-digit returns. It's India and Taiwan, and the EM experience of the dollar investors has been very bad across most of the emerging markets, negative returns for 10 years. And India offers a very wide range, a deep range of stocks, more than 600 stocks with more than $1 billion market cap and attractive ROE. So I'm quite confident once the macro concerns on currency gets clear and there is visibility on the recovery in earnings, I think the FIs will come back. For 4 years, we have had negative inflows from the FIs, yet Nifty has given a 12-13% compounding. And domestics have clearly given a lot of support to this market. So my sense is sometime later this year, once the currency view gets clear, once the trade war risks have reduced, I think they'll come back to India. And that should aid the large cap performance as well, because FIs typically invest 70-80% of their flows into the large caps, and their exposure to broader market is relatively much less. Then lastly, coming on to the large cap fund, quick update on the positioning and the strategy, and then we can open it up for Q&A. So in terms of strategy, this follows a blend style, a blend of GARP and value. And I believe that a blend style, if executed well, has potential to create consistency in performance in the large cap space over a 3 or 5 year return framework. Because if one gets stuck to one particular style, then one tends to do well when that style is favorable in the market. And when the market preference changes for style, another set of funds start doing well. So I think a blend style, if executed well, has potential to create consistency over a 3 or 5 year framework. And that is my aim and that is my goal. So for example, in this fund, 2.5 years back, the growth value mix was about 50-50. And now it's become 3/4, 1/4. So 3/4 is growth biased and 1/4 is value biased. So 50-50 has moved to about 75-25. Portfolio construction done on a bottom-up basis and blended with top-down trends. A lot of attention to how business sector and valuation cycles are moving in background, and very conscious on valuations throughout the investment journey. And typically a 45-50 optimally diversified portfolio, not too concentrated and not too over diversified. And the approach clearly is to build portfolios with a medium to long term 2-3-4 year perspective. In terms of risk management, there are some guardrails in place in terms of number of stocks, like I mentioned, around 45-50. Some sector deviation framework is also there. And in terms of benchmark overlap, this product historically had a 50% benchmark overlap minimum. So that broadly continues. and yet active bets are taken, and some high conviction contrarian bets continue to be taken over here. Lastly, in terms of positioning, it's more a bottom-up portfolio with these as sectoral outcomes. Top-down, I think private banking and telecom is, in terms of sectors, is where I'm more bullish on. Rest, in terms of positioning, is more of outcomes based on bottom-up positioning. So the current positioning is showing an overweight on healthcare, telecom, and consumer discretionary, and an underweight on energy, IT, and materials. The IT underweight has been reduced a lot in the last couple of weeks, months, and the rest of the sectors are more in a plus minus 0.5 neutralish zone and more of a bottom up stock picking in these sectors. So that's the positioning of the fund. So I've kind of given some perspective on the economy, the short-term slowdown, why I'm optimistic that things will get better on the various fronts, some views on the various concerns in the market in terms of earnings, valuations, global issues, a reinforcement of what we said in October 24 on valuations and mean reversion, and the large cap positioning. I'll hand it over to Ashok ji now to take it further.
Thanks, Rahul, for your comprehensive overview of the economy, market valuations, and the positioning of our large cap fund. Uh, if you can just remove your slide, this I just again want to show that slide which I showed again. If you can just stop sharing this, and so sorry. So this was a slide that we were talking about before we handed over to Rahul, and we talked about HDFC Large Cap Fund. It is a fund which is in existence for more than 28 years, 29 years of its operation is going on. And this 20th year has a rich history. Why I'm saying that this fund has seen so many ups and downs of the market, beginning with the Asian crisis of 1998 and tech bubble of 2000, then 9/11 terrorist attack in US, and then global financial crisis, and thereafter NPA struggle back in India, trade war between US and China, which again has resurfaced. In between, COVID also happened. And of course, the periodic ups and downs happening in the market. And why I'm saying that to become financially successful, what you need is discipline and patience. For example, today also, if you see the 1 year SIP, if you have invested 1,20,000, there is 10,000 a month. It is around that level only, around 1,20,000. But as the period continues to improve, for example, after 5 years, if you say 6 lakhs, it is close to 9,70,000. You go further, 12 lakh becomes 25 lakh, and 15-year becomes 18 lakh becomes nearly 55 or 56 lakhs. And if you go since inception of that 28 years, then 34 lakh becomes 852. So idea is that people tend to take unpleasant decisions based on the recent market movements or even a performance of the scheme, while not giving due credit to what this fund stands for from a medium to long term perspective, having seen so many ups and downs. So if today, for last 5 months, if we are seeing a challenging situation in terms of market movement, the idea is not to lose heart, because India still remains one of the fastest growing economy. Government is very proactive, RBI is proactive, and they are taking necessary steps. But those steps take some time to take its effect. That's what Rahul explained. And then he said probably by another 6 months or very close to Diwali, you will see things improve much better than what they are today. So the success of financial success remains the same thing, that if you remain with a fund which has a long history of having seen ups and downs in the market, then the prospects of you turning out a better result for yourself also improves over a period of time. So that's what we wanted to. So thank you for being on the call. Thanks, Rahul. Thanks, Sandeep.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.